This is Invested in Climate with Jason Rissman. I see climate as the world's biggest, most diverse, most important movement in human history. Millions of people dedicate themselves every day to protecting the planet. This podcast shares conversations with advocates, entrepreneurs, investors, policy experts, and anyone else that can push our thinking about what's possible and what needs to happen to address climate change. If you have ideas for episodes or feedback, get in touch on LinkedIn. If you enjoy the show, please leave a rating on Apple or Spotify. I'm currently building a new venture. It's related to storytelling and how we engage all sorts of folks in meaningful climate action. If you have expertise in this area, big ideas, or examples of something that's really working, get in touch. Thanks for listening and for doing whatever it is you're doing to support climate progress. Okay, let's get started.
Where's the sweet spot for long-term removal, low cost, high quality, high yield? And we basically came to the conclusion that it was going to be in land restoration, where the biggest input cost, which is land, would be free. So we were like, where's the land free? And it's basically in desert.
Hi, everyone. The voluntary carbon markets have been a source of curiosity for me. There's been a lot of hope that the market would mature and offer a reliable way to offset emissions that otherwise could not be eliminated. Reliability has been the problem, however. Not knowing which carbon reduction projects are additive and truly remove or reduce carbon has held this market back, and I've been excited to learn about how new technologies will enable the reliability that's needed. There's many people working on this problem. Dr. Allister, founder and CEO of Sylvera, is one, and I was excited to learn about his company's approach to removing carbon market bottlenecks and accelerate the investment in carbon projects. As he says, it's a mix of software, data, AI, and analysis that have helped Sylvera work with large clients and unlock enormous investments. Hope you learn as much as I did. Enjoy. Hello, Allister. Welcome to Invested in Climate.
Hello. Glad to be here.
Thanks so much for being here. Where are you dialing in from today?
I'm dialing in from the UK, from sunny Brighton, which is basically on the coast. It's about an hour south of London. That's where I live. So I'm on a kids' afternoon today. So I'm going to go hang out with the kids by the beach shortly.
Fantastic. Well, I do hope that you get some sunshine on the beach. I'm aware that London Climate Week is coming up soon. We just had ours in San Francisco, and really exciting to see the size and range of activity this year with almost 600 events. Is the London Climate Week such a big affair as well?
It's funny. Yeah, I was talking to someone about this, and they were saying how, compared to New York, San Francisco is a newer event. And I think it was the same deal with London. The first time round, maybe the second time, it felt a little bit like sparse. There wasn't that much momentum. Last year, it was crazy. It was like back to back. There was no way you could get around anything. We're just coming up to London Climate Week in a few weeks. So I'm expecting, a bit bigger and better. And that's a positive sign, right?
Fantastic. Good luck and have fun with that. Let's dive in as there's so much to discuss. And let's start with learning a bit about you. You're a repeat entrepreneur with a long history in climate. Give us a quick overview of your background and how it led to the work that you're doing today.
Awesome. Yeah, I'll try the super quick version. Always interested actually in too many things. Interested in climate, interested in AI, interested in biology. So I did a neuroscience degree, specialized in AI, also interested in entrepreneurship. Did the natural thing after a neuroscience degree, started a clothing label. This was way back in the day. There was not much of a tech scene in the UK. It was the thing you could start with a few friends and not a lot of money. So I built the website, we built the supply chain, and then we figured out how to make a business. At the same time, we realized that we were not into fashion. You might be able to tell. And we reset the clock, went our separate ways. I went to, again, follow my passion in AI. I did a PhD in AI, but what I wanted to do was build something that I could use for some positive effect, ideally a climate related one. So I did a PhD on wind energy systems and particularly using AI to control wind energy systems with a view to spinning that out into a business, which we did. I found a co-founder crazy enough to build this business. We raised money from Shell, Schlumberger. It was not really a kind of classic Facebook kind of tech business, but it was a very deep tech business. And we sold that business a few years ago. And after having a couple of kids and having a bit of a safe harbor, helping other people start businesses for a few years in a place called Entrepreneur First, which is a incredible experience. The kind of bug bit again. In fact, it was just always there. And yeah, the view this time was to take some of the learnings, some of the tools I built, and apply them to where I could have maximum impact. And the original thinking behind Sylvera was take the learnings from the renewable industry, which has scaled so much, and apply those to climate in terms of carbon removal. So the problem is, despite all the efforts and the sort of energy transition, we've been too slow. I think it's pretty clear. And we now need to remove billions of tons of CO2 from the air out in for the next century or so. We're going to have to just ramp this whole new industry up. And the quicker you do that, the faster you do it, the better from a climate perspective. And it's going to entail spinning up an industry the size of the renewables industry. So the idea was take some of the learnings from that place, apply them to carbon removal, and we followed the thread from there. And that ended up becoming Sylvera.
Thanks, Allister. Let's dive in and hear more. You said you were applying lessons from the renewables industry and applying them to carbon removal, and that led to Sylvera. Tell us more about the founding of your company and the problem that you're trying to solve.
Yeah, awesome. Thanks, Jason. Sylvera, as it is now, is basically building a set of tools that was actually solving problems that we encountered while trying to start a completely different business. Kind of harking back to the thread on renewables, the thinking we had at the beginning of Sylvera was this. In renewables, it's all about cost, right? You got to try and outcompete coal or outcompete gas or the fossil fuel generator. And to get the cost down, you've got only a few factors. It's basically like CapEx, how much does it cost to install your system, get it running? OpEx, how much it costs to run the system? How much it costs you from capital perspective, like the borrowing the money to the debt, the equity to finance that. And then the yield of the system that you've just built, like how the capacity factor, how much it produces compared to how much it could. So basically by maximizing those factors or optimizing them, you're going to squeeze the cost of energy down. And that's what's happened in renewables over the last few decades. Year on year, incredible cost reduction. So we were thinking, similar is going to apply. No, there's no reason why the same thing wouldn't apply in carbon removal or emissions abatement, avoiding emissions. And we went through this thought exercise and we were like, where's the sweet spot for long-term removal, low cost, high quality, high yield? And we basically came to the conclusion that it was going to be in land restoration, where the biggest input cost, which is land, would be free. So we were like, where's the land free? And it's basically in deserts. And we basically went through this whole process of determining which deserts would be most amenable to being greened over the next century. And you're building tech to identify that, have landscape scale interventions to accelerate regreening deserts. And why I say accelerate, it's because the only deserts you can regreen are the ones that are going to regreen anyway because of changes in rainfall, because of climate change. And basically, that will happen by itself. So there's areas of the world that are going to regreen, but might take 1,000 years, 5,000 years to do that. And the idea was find those places, apply interventions, and hundreds of billions of tons of carbon. So that's very material from a buying time for the world perspective at the lowest possible cost. So we thought we were doing great. We were like, great, this is going to be move the needle. It's an AI play where you're leveraging AI to unlock the opportunities of how to do this. You have to do it with software. You can't hand crank this. And then I know this guy at JP Morgan, and we're still with this renewables mindset. We were like, great, we've got people interested in buying this carbon. We've done this work. We need to borrow like $100 million. And he just laughed. He was just like, no. If this was power, sure. Carbon, it's not a serious market. But it's basically his words. I think he used stronger words actually than that. But he was like, it's not a serious market, full of fraud. You'll never reliably get the price you're expecting, because even though the project's like a hyper premium project, people will undercut you that are willing to compromise. It's a dysfunctional market. And we were kind of like, well, why? And it's basically, as has come out in the media, there's a lack of trust because many of the projects in the market were saying that they were achieving things that they weren't. In kind of an economic sense, it was a market for lemons. Like everyone said they were great, and then hidden among actual genuine projects were a lot of lemons, like projects that were not good. Nobody could tell which were the lemons, which ones were the good projects. What that did create lots of controversy and basically made the projects uninvestable, like too much risk for anyone to underwrite from a lending perspective, too much uncertainty for people to undertake long-term contracting. And you need the long-term contracting to underpin the finance. So we were like, wow, we had this thesis and we thought we could sequester these 100 billion tons more. What other projects are out there? Like basically every possible solution to carbon removal is going to be hindered by this data problem. So then we pivoted the company to providing data that solved this weighing of impact. And that's what became the first product line of Sylvera, was ratings, rating the impact of projects and the credits that they issued so that the buyers could figure out which ones were real, which ones were not real, which ones needed some work. And then they can figure out what value for money is. They can think about planning long-term agreements. The projects become fine. And you kind of catalyze growing up of carbon, like normalizing this kind of, people say the Wild West, normalizing this asset class that was very nascent and wasn't ready to scale. We ended up, we were trying to regreen the Sahara. We ended up with a ratings agency. That was kind of the journey.
You've sold me on both, and I promise we'll spend most of our time talking about Sylvera and the larger macro problem that you're solving, but I am now intrigued about greening deserts. Is anyone pursuing the vision that you first set out on? Is that actually a viable path once we improve, I guess, the borrowing ability for projects like that?
There are a few people doing some related stuff. This is the sort of give me 2 drinks in the pub and I'll give people the business plan and like everything. I just think somebody should go run at this hard. We can't do that, whereas it's just a completely different business now.
Thanks, Allister. I definitely hope someone takes you up on that offer of a business plan in exchange for a couple of drinks. Now, let's keep going on Sylvera. What exactly is the company offering?
We describe the business as ratings, tools, and data. So what we're trying to do is solve bottlenecks to deployment of capital. And sometimes those bottlenecks are solved by a tool, sometimes by information. Sometimes to get that information, you have to go and do some pretty innovative things on the science with AI. But ultimately, much of that is hidden and the complexity is hidden. So you're just trying to allow people, we say our mission is incentivize investment in real climate action. You're basically trying to allow people to do well by doing good or do the good they want to do while managing risk. And so managing the downsides. You're trying to skew the incentives in favor of climate action, reducing the downsides, increasing the upsides, allowing people to get stuff done. What that looks like is a kind of a set of tools. And the core one that we started with and that we're most known for is this rating product. So there's a question of like, how do we get to those ratings? And there's some interesting kind of software and science that I can go into there. But to stay at the high level of things we offer, that's great if you want to buy credits from a project that's already up and running. But if the sector is to grow, you need new projects to get investment, new projects to have purchase agreements from buyers. And that needs a different type of assessment because the rating is basically seeing how something is doing once it's up and running. Up and running for a carbon project is called issuing. The project every period, every year, typically, it gets to issue these credits to reflect its activities. But you also need assessments to test whether projects that are in development phases are any good. And that's good on 2 respects. One, are the credits going to be high quality? And 2, how many credits will the project actually deliver? Because you've got a quantity question as well. So that's a different kind of question because it's a different need you're trying to solve for. It's, should I invest in this project? The credits might be great, but they might be over-claiming what they can deliver and the project will go bust and that would be bad. Or you could have the inverse where they can deliver tons of credits, but their quality will be low and the demand, the climate argument goes out the window, then climate impact goes out the window. But in any case, the price will be depressed and you might not even be valid those credits. So that's a different set of tests. We call those pre-issuance ratings. Then you have a different set of challenges, which is like, I can see these projects are good and I can buy the credits and I can comfortably retire them. Great. I can invest in projects. Great. But the economic angle is like really important here. People are spending lots of money. And historically, people have spent that money very inefficiently. And that's to say 2 things. They've been buying credits that are poor quality for actual money. And credits, in some cases, has 0 impact and spending real money on 0 impact. So that's not good. And then you have other cases where people are buying credits with real impact and they're overpaying. So they're just paying more than they should. There's some middleman or intermediary that's taking a huge margin. And there's value that intermediaries, marketplaces, brokers, exchanges provide. But over time, mature markets, the value accruing to the middleman can get more fair and more transparent. And in this space, we've seen very egregious cases of profit taking, the worst of which was a 23 times multiple. So somebody's bought something and at one price from the market, and they've sold it to the end user for 23 times what they've bought it. And that's just taking advantage of the buyer's lack of information. So the third thing that we provide increasingly is price information and access to the market. So if you're let's just say you're a tech company, you could be like automotive, business, airline, anything. To access and interact with the market is very difficult. So we built a tool called Connect to Supply that allows the buyers and sellers to discover each other. We don't charge them for that discovery, but then a buyer can typically get multiple quotes and they can find the credits that they want. We're an information business, so then we get to see the prices. And we also combine that price data from the quoting, and we'll probably do around $1 billion of quoting on the platform this year. So we get all that price signal, and we augment that with this. We've got about 250,000 data points of price. And that allows us to give people very confident price signals. And having confident price signals is really important because it allows budgets to be set. It allows planning going forward. It's boring, but it's really important. And we now also have a very sophisticated capability modeling the market going forward. So if you're investing in renewables, in a gold mine, in a copper mine, in any kind of asset that produces something, what you need, you actually require it. The bank will need you to have a third-party provider of information that projects what the prices will be in future and what their sensitivities are to certain things. So we help with that. And we also provide, I guess, probably a couple of other things, but like the other one we're very well known for is geospatial data. To make our ratings, we have invested very heavily in improving the accuracy of monitoring forests from satellites. And we always just bundle that data was trapped in our ratings. And now it's been recognized by a number of parties that it's the best product there is. There's no more accurate measure of forest carbon. So we have unbundled that. And now we're working with a number of actors who are using that data, or we're building tools for them to use that data. Just the suite of offerings. And there's no one single thing that's in this problem, in this market. You need quality, you need a view on the future, you need to be able to test things. So we have this store cupboard of ingredients that we assemble to solve those needs. So less clear cut, but more interesting and more flexible as how the business has evolved.
Great. Well, Allister, you painted a picture of a complicated market with lots of problems. And actually, you said that your business is really there to remove bottlenecks. And I think that you've pointed to several bottlenecks that you're working on. Give us a sense of how the company is going. You've been at it for several years. Tell us a bit about the company's progress and reach and how many projects you've been able to support and some of the clients that work with you.
Yeah, awesome. So we work globally. It's our key metrics. We've raised around $100 million by big names like Fidelity and Index Ventures, Insight Partners. We have around 140 employees. We have our main offices, externally facing offices are London, Singapore, and New York. We have a very relatively even split of our client base. It's about 30% APAC served out of our Singapore office, and then 35 EMEA. Americas is roughly where it's at. APAC has been growing faster. It's probably will overtake the other offices, the other kind of regions in the next 12 to 18 months. We have analysed or have a published assessment on around 2,000 projects at the moment. So that's over 90% of the volume in the market. And then in terms of who we serve in those geographies, in a number of buckets, in terms of industries, the big ones would be technology, energy, finance. And you do also see, so that covers about 2/3 of the business, just those three verticals. And then you'll see a number of funds, traders, people in insurance. So there's like a long list of other businesses that kind of use this data. And yeah, like names, there's a lot of our client base is rather private, but we work with, say, so you can't name them, but the top 3 management consultancies we've worked with for years as clients of ours. Our first customer actually was one of those. They were the first people that didn't think we were crazy. And we go back a long way with those businesses. We deal with about 10 banks globally. So the biggest American banks, for example, and energy companies as well, for example. So in banking, Morgan Stanley, I think we've been able to talk about that. In energy, Shell. In tech, maybe Airbnb. And then we also serve some of the public sector. So the government of Singapore is a customer we were announced, we've had a partnership with them for a number of years and have been doing great work with them. And I guess why they come to us is, and we actually had this, in fact, one of those like very top tier clients for quite a young business. People come, and I think at the moment we're serving 4 and soon hopefully 5 of the top 15 businesses in the world by market cap. One of them very early on said, we'd rather not come to you because at this point we'd only been 2 years old or something. They were, candidly, we'd rather buy from big brand X or big brand Y. And you were the only ones that could solve this problem for us. And as we've solved those hard problems, we can solve more hard problems. So then people keep coming to us. We specialized in problems that nobody else could solve. And that's been behind a lot of our growth.
Allister, many companies around the world are backing away from their climate commitments. You have front row seats on this. Are companies really changing what they're doing in practice? What are you seeing?
Right. This is an interesting question. So I would question whether the substantiveness of many of those commitments in the first place. So what we see behind the scenes, to be honest, is still almost unchanged. The historic view was the CEO will come out saying, we're going to be net zero by 2030 or something, even when the business is like a big, heavy emitter. And you're like, how are you going to achieve that in this time? And maybe it was a bit of a shoot for the stars, land on the moon kind of thing. But over time, that horizon comes and you have to face the music a little bit. You're seeing more realism and pragmatism there. People being like, we're not going to hit that target. We're going to push the target back. Actually, internally, they're continuing to ramp their programs. And actually, this is maybe two sides of the same coin. We're working with one big asset manager at the moment, and here's the commitment that we have and we are sticking to, and the board's behind it and we've committed it to externally. The unwrapping of that into actual reality that we can actually do stuff, we're actually going to spend money, and the budgets have to be set and the capacities have to be built. And it's, wow, this is a lot of work. It's expensive. And in that case, we're helping them basically deliver that and then bringing some of the data and tools to like reduce the cost. You can really strip out a lot of the costs, and then we're able to allow them to go ahead and do it. And they're not actually pulling back on that commitment, but they're not a big emitter. It's an asset manager. They don't have loads of emissions. But many businesses, they're like, we literally cannot pull the levers fast enough to deliver that by 2035 or whatever the target was. We're going to push to 2040. But it's almost as a function of actually doing the stuff that they realized, oh God, like, you know, so it's not like they're just not been doing anything and they're just downing tools. It's just everyone's, wow, this is really hard. Basically naming what everyone actually maybe deep down knew, because if those 2030, 2040 targets in some cases were going to be delivered, the business would have to be on like a war footing to a point where they would have to like disclose the impact in their financial statements. And you couldn't see any shadow of the activities in their financial statements. So it wasn't happening. So people were saying one thing, doing another. So actually, I don't think the underlying reality has really changed. The mood music has changed politically. The pragmatism is coming in, but the pragmatism is not because they just don't want to do it. It's because they're actually doing it and realizing it's going to take a ton of time.
Allister, you've described a market where companies are continuing to invest and really maybe with more nuance and realism around what they're able to achieve. What do you think that means in terms of corporate demand for climate projects and carbon projects? How will it impact Sylvera's growth and impact?
Yeah, so it's a good question. If you look at the market on the voluntary side, it's tiny. The base is so low to have any meaningful impact or to deliver even a portion of the climate commitments. You have quite a huge amount of growth baked in. And this is what you see in reality is the very bullish estimates that banks and consultancies and think tanks were putting out maybe around 2020 haven't manifested. So the base is still low, effectively. I think that is fair to say. What is a steady uptick, and we're seeing that this year, we do expect to see the market return to material growth, as in like tens of percent, rather than basically hovering flat, which it has for the last 2 or 3 years. The backdrop to that is, one, these voluntary commitments, and two, the policy trajectory, which basically is giving more role for what we'd call project-based credits that emerge from tightly defined projects, more role for those in compliance systems. So that would be, you have a tax obligation or you have to buy an emissions allowance, but in substitution of that, you could buy a credit from a carbon removal or avoidance project. And that's basically driving a bunch of the growth. So the kind of obvious example of that is Corsia, the aviation sector's collective commitment to purchase carbon credits again and offset them against growth in aviation above a 2019 baseline. And that kind of bakes in a certain amount of demand. When a government in, for example, Colombia or Chile, they say, or China, actually, I should just probably started with China. They have a big emissions trading scheme. And they say a portion of the obligations under that scheme, you can buy these credits that guarantees the market will multiply and scale, like more than double just that one single scheme as that program gets rolled out. So you can kind of add these up, and this is how we model out the market going forward. And in a way, that catalyzes the voluntary demand because you start to compete for the same kind of credits. And this is one thing, this is an information problem again. If the CFO realizes that I can save $10 million by acting early and starting to buy credits early and contracting now, rather than wait 3 or 4 years, then they're going to approve that budget. So they're going to be like, okay, just start early, get ahead of things. And that realization is gradually trickling down. And we try to bridge this gap between finance teams and the sustainability teams. They don't often have the data, but we have all this market data. So we can say, well, here's the cost of buying off the market right now. Here's the cost of contracting forward. Here's how the market is likely to evolve given these policy pathways. You design your strategy and typically it brings that action forward. So we're not like, we never were like to the moon sort of bulls for carbon. And you see these pathways for growth now that are frankly much more reliable than CEO X says in 5 to 7 years when I'm probably gone, this thing will happen. Budgets, planning, economic optimization, regulatory compliance, they are much more reliable, like drivers and indicators of demand going forward.
Allister, it sounds like you have some policy expectations that are baked into your assumptions around your company's growth and the evolution of the carbon market. Give us a really high level view of how you think that policy market internationally is going to change.
That trend I mentioned where there's use cases being created for these project-based credits in a broader set of use cases than just like doing it voluntarily. So the voluntary carbon market is just that voluntary action. Where those types of credits are used in compliance markets, we call that convergence. It's not just us. That's the trend that's happening. And the compliance markets are a factor of around 1,000 or at least 500 bigger. So that convergence trend, it's behind many of the funds in this space. They are investing predicated on this assumption that these carbon credits, especially now they've been cleaned up, the quality of them is more easy to determine. And that's the ratings agencies like us have played a big part in that. It becomes more predictable. This specification of credit and this grade will be usable in China or in Singapore or in Japan or in this context. Therefore, now I can invest in it. So that convergence trend is a huge one. And then I think, and this is maybe, you could do an entire second podcast on this, which is like when the bill goes up, it comes out of marketing sustainability and it lands into procurement and finance. And then when you start going into procurement and finance, these rational questions get asked. These are really good ones, which are like, hold on, there's no free lunch here. I can meet my tax obligation, my emissions tax obligation. You're pulling different levers. So I can buy a carbon removal credit. I can buy an emissions allowance, or crazy idea, I could reduce my emissions, which is great. You need to price the externality so high that it funds the decarbonisation activity. So then you start to see this question. So you could be, say, like a power company, and you could be like, or a manufacturer, and you could be like, now I'm thinking, should I buy green steel? Should I make sure my steel supplier uses green hydrogen, or my power station, I'll co-fire green ammonia in that? And you start to see a equivalence between different types of green commodities and what you'd call EACs, the certificates that sometimes get split off, like a renewable energy certificate. Those things are being thought of as just different sides of the same coin. And then so there's a secondary convergence, which is like, oh, now the carbon bill is material. I'm going to think about all my levers collectively, which is exactly how the thing should work. You're trying to get the maximum climate impact and actually deliver it, but minimize the costs. And then as the cost gets excessive in one area, you go to the next low-hanging fruit, So the convergence of all these tools is actually a really healthy thing. But again, you need good quality data, and that's actually not necessarily true in those other markets either. So probably more development to come there.
Allister, you mentioned that you've raised nearly $100 million from leading climate tech investors for your company. How would you describe climate investor sentiment today, and amidst a range of macro factors, including inconsistent corporate and government appetite for helping climate solutions scale?
You have different pools of capital at different stages of businesses. I think the venture was behaving a bit irrationally for a while around that COVID period, and shortly after, there was a flood of money into climate tech businesses that was maybe not the most rational. So I think You're seeing greater focus on fundamentals all over the place, and climate is not immune from that. Arguably, you see some irrationality in AI investing as well. In general, you're seeing more focus on fundamentals. So this comes back to the policy story or to the technology stories. Something has to move economically, whether it's demand driven by policy, whether it's cost driven by technology, that has to be like needle moving, has to be 10x, and that's divestible. So you see greater thoughtfulness and sophistication from the investors, and it's a bit less spray and pray. It's definitely lost the kind of buzziness, but it's probably a little bit more rational, healthy as a result.
Great. Allister, let's wrap up by looking a bit further out, 5 to say 7 years from now. Tell us how you see the carbon markets evolving and how much they will contribute to addressing the climate crisis.
What you really want carbon markets to be is big and boring. For a number of years, they've been small and interesting, perhaps in the wrong way, like high on controversy, great for generating outraged column inches. And you see analogies with other markets in their nascency. So bonds and bond markets is a good example. Like railroad bonds were like the big boom of the bond markets, and loads of people lost their shirt in that. And we're talking like 100, 150 years ago here. And that was very controversial. That was the origin of the ratings agencies. So that's where Moody's, Fitch's, Standard & Poor's, all their roots go back to the railroad bond boom and needing to turn that asset class from like small, hypey, controversial into big, dull, and actually needle moving. That's where we would hope carbon to go. A lot of that is around the data. We're part of this big cross-industry, multi-stakeholder international effort to just standard. It's called CDOP, Carbon Data Open Protocol. Definitely not in the kind of sexy, controversial end of the spectrum. It's one of our co-chairs said, it's the sort of thing that gets you disinvited from cocktail parties because it's just the grind that is required to build a market. It's like here, so we've been through like all the different ways of defining this credit. You need them just to be standardized so that a bit of software can read them. The market can scale. You don't want consultancies and like people poring over millions of pages of PDFs. It doesn't work. That's part of market infrastructure. Having the governance, that's actually required, that data definition for compliance markets, for voluntary markets, and for markets between governments under Article 6 to converge. You actually need to be able to just compare some data fields with one another and maintain registries and transact using like something that's digitally defined. So that digital definition, scalability, consistency, big trend. How much will they contribute? An increasing amount, but like a significant multiple of where we are, but not in the necessarily directly obvious way that, that they're a tool for pricing in this externality, the free lunch that everyone's had for like human history. You could emit 1 billion tons tomorrow, unless you're in the EU as a steel producer, it's free. Or like in certain cases, you could do 10 billion tons. It doesn't cost a penny. It's crazy. The bigger effect is in like closing the net on emissions and then driving expenditure in emissions reductions, which is that's the job one to do, is reduce the emissions. So a bunch of the impact of carbon markets, if configured correctly and the price be high enough, would be to actually that you'd see the benefit in people are like, I'm just going to reduce my emissions because this is just too expensive and too heavy to get involved in all of this carbon stuff. So yeah, less controversial, less interesting, more embedded in the financial system and in the actual levers of decarbonisation, but effective nonetheless, hopefully.
Allister, thank you so much for your time today and best of luck with all the work you're doing.
Pleasure. Thanks, Jason.
Thanks for joining us for this episode of Invested in Climate. Please remember to rate us on Apple, Spotify, or Google. Find show notes, sign up for updates, get in touch, and visualize your climate action at investedinclimate.com. This podcast is for informational and entertainment purposes only and does not constitute financial, accounting, or legal advice. Thanks again.